Financial instruments are among the most technically complex areas within IFRS accounting standards because they involve recognition, classification, measurement, impairment, disclosure, and risk management. IAS 32, IFRS 9, and IFRS 7 collectively establish the framework governing financial instruments in international financial reporting. A financial instrument is defined as any contract that gives rise to a financial asset for one entity and a financial liability or equity instrument for another entity. Financial assets include cash, receivables, investments, and contractual rights to receive cash or other financial assets. Financial liabilities include obligations to deliver cash or financial assets. These standards aim to improve transparency, comparability, and consistency in reporting financial risks, financing arrangements, and investment activities within global financial markets. Classification of financial instruments is essential because it determines how instruments are measured and presented in financial statements. Under IAS 32, instruments are classified as financial liabilities or equity based on their contractual substance rather than legal form. Equity instruments represent residual interests after deducting liabilities, while financial liabilities involve contractual obligations to transfer cash or another financial asset. Compound financial instruments, such as convertible bonds, contain both liability and equity components and must therefore be separated on initial recognition. The liability component reflects the obligation to pay interest and principal, while the equity component represents the holder's conversion option into shares. Accurate classification is critical because it directly affects reported liabilities, equity balances, financing costs, and earnings measures within financial statements. IFRS 9 introduced a principles-based approach for the classification and measurement of financial assets using both the business model test and the contractual cash flow characteristics test. Financial assets are classified based on how entities manage them and whether contractual cash flows consist solely of payments of principal and interest. Assets held to collect contractual cash flows are generally measured at amortized cost. Assets managed both for collection and sale may be measured at fair value through other comprehensive income, FOCI. Financial assets held for trading or failing contractual cash flow criteria are measured at fair value through profit or loss, FVTPL. This framework ensures that accounting treatment reflects the economic purpose and cash flow characteristics of financial instruments appropriately. Initial measurement of financial instruments generally occurs at fair value, often adjusted for transaction costs depending on classification. Subsequent measurement varies according to classification categories established under IFRS 9. Financial assets measured at amortized cost use the effective interest method to allocate interest income and amortize premiums, discounts, and transaction costs over the instrument's life. Financial liabilities are usually measured at amortized cost unless designated at fair value through profit or loss. Equity investments may either be measured at fair value through profit or loss or, in certain cases, designated at FOCI. Changes in fair value affect either profit or loss or other comprehensive income depending on classification. These measurement principles ensure consistent recognition of financial performance and risk exposures within financial statements. Impairment accounting under IFRS 9 represents a major change from previous incurred loss models by introducing the expected credit loss, ECL, approach. Entities must recognize expected credit losses from the time financial assets are initially recognized, even if no actual default event has occurred. The impairment model applies primarily to debt instruments measured at amortized cost or FOCI, lease receivables, and contract assets. The ECL model uses forward-looking information, including historical experience, current conditions, and future economic expectations. Financial assets move between stages depending on changes in credit risk, affecting the amount of impairment recognized. This proactive impairment approach improves transparency and ensures earlier recognition of potential credit losses, thereby strengthening the reliability of financial reporting information. Derecognition principles determine when financial assets or liabilities should be removed from financial statements. A financial asset is derecognized when contractual rights to cash flows expire or when substantially all risks and rewards of ownership are transferred. If risks and rewards are retained significantly, derecognition is generally prohibited. Financial liabilities are derecognized when obligations are discharged, canceled, or expire. Derecognition rules are important because they prevent inappropriate removal of assets or liabilities and ensure that financial statements reflect continuing exposure to risks and obligations accurately. Transactions such as securitizations, factoring arrangements, refinancing, and debt restructuring require careful assessment of derecognition conditions to ensure compliance with IFRS accounting standards and faithful representation of economic substance. Hedge accounting under IFRS 9 allows entities to align accounting treatment with risk management activities by reducing mismatches between hedging instruments and hedged items. Hedge accounting can only be applied when formal documentation exists. The hedging relationship is expected to be highly effective, and effectiveness can be measured reliably. The standard recognizes three primary hedge types: fair value hedges, cash flow hedges, and hedges of net investments in foreign operations. In fair value hedges, gains and losses on both the hedging instrument and hedged item are recognized in profit or loss. In cash flow hedges, effective hedge portions are recognized initially in other comprehensive income and later reclassified into profit or loss when the hedged transaction affects earnings. Overall, IAS 32, IFRS 9, and IFRS 7 provide a comprehensive framework for accounting, measuring, disclosing, and managing financial instruments within international financial reporting. These standards improve transparency by ensuring that financial risks, financing obligations, investment activities, and hedging strategies are reflected accurately in financial statements. Through principles governing classification, measurement, impairment, derecognition, and hedge accounting, IFRS enhances comparability and supports informed decision-making by investors, regulators, creditors, and management. Financial instruments significantly influence liquidity, solvency, profitability, and risk exposure, making this topic one of the most critical areas within the DIP-IFR syllabus. Mastery of these standards equips accounting professionals to manage increasingly sophisticated financial arrangements in modern global markets.